What I'm about to reveal could be the difference between protecting your life savings and waking up Monday morning to discover your bank no longer exists. And I'm not being dramatic. 5 days ago, this exact scenario played out in Chicago when Metropolitan Capital Bank and Trust was seized by regulators on a Friday afternoon with zero warning to customers. Today, I'm walking you through 12 banks that public regulatory data shows are facing the same deadly combination of risks that have destroyed every major bank failure in recent history. These aren't obscure institutions you've never heard of. These are banks processing billions in transactions, holding mortgages for hundreds of thousands of families, and managing payroll for major companies. Your money might be sitting in one of them right now. Here's what you need to understand about how bank failures actually work. The containment protocol. It's the regulatory playbook designed not to protect you, but to protect the system from panic. Examiners spot problems months in advance. They downgrade internal ratings. They demand remediation plans. And they tell absolutely no one outside the bank's executive suite. Silicon Valley Bank proves this isn't theory. Federal examiners knew that bank was circling the drain. They'd flagged the risks. They'd issued confidential warnings. But on March 8, 2023, when Silicon Valley Bank announced it needed to raise capital, depositors were blindsided. Within 24 hours, $42 billion fled the bank. $42 billion in a single day. By Friday afternoon, regulators seized it. That's how fast confidence evaporates. One day you're banking normally, the next day your accounts are frozen, and you're hoping the government decides to make you whole. And here's the critical part most people missed. The government did step in for Silicon Valley Bank depositors, but Treasury Secretary Janet Yellen made it crystal clear this was a one-time systemic risk exception, not policy, not precedent, one time. Now watch what Warren Buffett did during this chaos. Nothing. He didn't scramble. He didn't panic. He wasn't caught off guard. Why? Because Buffett had already been selling bank stocks for over a year before Silicon Valley Bank collapsed. He saw the same data I'm about to show you and made his move before the crowd figured it out. Between mid-2024 and mid-2025, Buffett dumped over 400 million shares of Bank of America. He exited Citigroup completely. He's been a net seller of stocks for 11 straight quarters, pulling $174 billion more out of equities than he's put in. And what's he buying with that money? Treasury bills, over $300 billion sitting in government debt. That's not portfolio rebalancing. That's Buffett voting with his money that bank stocks aren't worth the risk at current prices given current conditions. And the conditions are brutal. 3 pressure points are converging on regional banks simultaneously: commercial real estate exposure, unrealized securities losses, and deposit flight. When all 3 hit the same institution at the same time, you get what happened to Metropolitan Capital, what happened to Silicon Valley Bank, what happened to Signature and First Republic. Let me break down these 3 killers so you understand what you're looking for. Commercial real estate is imploding, not struggling, imploding. Office buildings in major cities are worth 40 to 60% less than they were 3 years ago. Banks made $500 million loans against buildings now worth $200 million. That's a $300 million hole in the balance sheet when the borrower defaults. Florida Atlantic University tracks this exposure across every bank in America. Their data shows 59 of the largest 158 banks have commercial real estate loans exceeding 300% of their total equity. Regulators consider anything over 300% excessive. Why? Because if just 1/3 of those loans go bad, the bank's entire capital cushion disappears. They're mathematically insolvent. Unrealized securities losses are the silent killer. When interest rates were zero, banks invested deposits in long-term bonds. Safe, government-backed, predictable returns. Then the Federal Reserve cranked rates higher faster than any time in 4 decades. Those bonds lost 20 to 30% of their value overnight. Banks don't have to admit these losses exist as long as they don't sell the bonds. They're called unrealized losses, hidden in footnotes, ignored in headlines. But Congressional Research Service found 88 banks with unrealized losses exceeding 10% of their capital, 16 banks carrying over $500 million in paper losses, 7 banks sitting on over $1 billion. That's not a problem until depositors want their money back faster than the bank generates cash. Then the bank has to sell those underwater bonds and realize the losses. That's exactly what killed Silicon Valley Bank. Deposit flight is the accelerant that turns problems into catastrophes. Since the Fed started raising rates, over $1 trillion has moved out of traditional banks into money market funds paying 4 to 5%. Why would anyone leave money in a savings account earning 0.5% when Treasury bills pay 5% with zero bank risk? Banks experiencing deposit outflows face an impossible choice: match those rates and destroy your profit margins, or lose deposits and hope you can fund withdrawals without selling assets at losses. It's a death spiral either way. Now, let me show you the 12 banks where all three of these vulnerabilities are hitting simultaneously. This list is built from publicly available regulatory data: Florida Atlantic University Research, S&P Global Market Intelligence, Federal Reserve filings. Everything I'm about to tell you can be independently verified. Bank number 1, New York Community Bancorp. This is the textbook case of what happens when commercial real estate concentration meets rising rates. 57% of their loan book is commercial real estate, not diversified commercial real estate. New York City rent stabilized apartment buildings. When they reported a $2.7 billion loss in late 2023, their stock cratered 60% in weeks. S&P Global data shows their commercial real estate to capital ratio at 617%, the highest of any large bank in America. They've needed multiple capital raises just to stay alive. Without a merger, analysts question how long they can survive independently. Bank number 2, Flagstar Bank. Florida Atlantic University identifies Flagstar as presenting systemic risk due to the combination of size and commercial real estate concentration. They're big enough that failure would cause contagion, but concentrated enough that a commercial real estate downturn could wipe them out. Bank number 3, First Foundation, California-based. Heavy multifamily exposure in markets experiencing significant price declines. Here's the scary part: their unrealized securities losses approach their entire tangible common equity. On a mark-to-market basis, shareholder equity has already been eliminated. They're operating on accounting rules that let them pretend those losses don't exist yet. Bank number 4, Customers Bancorp. They grew explosively during the pandemic by courting cryptocurrency deposits. When crypto crashed and regulators started scrutinizing digital asset exposure, deposits fled. They lost a substantial portion of their funding base almost overnight, and they're struggling to replace it. Add commercial real estate concentration in Philadelphia and New York, and you've got multiple vulnerabilities stacking. Banks 5 and 6, Valley National Bancorp and Columbia Banking System, both exceed 300% commercial real estate to capital ratios according to FAU data. Both face exposure to property types experiencing the most stress. Any significant deterioration in loan performance could trigger capital shortfalls requiring immediate regulatory intervention. Bank number 7, Zions Bancorporation. Commercial real estate concentration over 300% in markets like Phoenix and Salt Lake City, seeing major property corrections. They were heavily shorted during the 2023 banking crisis because hedge funds spotted the vulnerability. They survived the immediate panic, but the structural problems haven't improved. Bank number 8, Western Alliance. Built their entire franchise on serving tech startups and venture capital-backed companies. That client base has been decimated. The easy money era is over. VC funding has collapsed. Their depositors are burning cash and pulling funds. During the 2023 crisis, they faced a classic run. They stabilized, but the business model pressure is ongoing. Bank number 9, Comerica. Texas and California focused. Deposit base shrinking as customers chase higher yields elsewhere. Net interest margins collapsing. Commercial real estate exposure growing because borrowers are extending loans rather than paying them off. Every metric trending the wrong direction simultaneously. Bank number 10, Synovus. FAU data shows commercial real estate exposure over 300% concentrated in southeastern markets experiencing office property stress. Size makes them systemically relevant, but concentration makes them vulnerable. Bank number 11, Home Street. Here's how you know a bank is in trouble. Management announces they're seeking a merger because they've determined they cannot survive independently. That's exactly what Home Street did. The merger has been delayed repeatedly by regulatory concerns. Meanwhile, they're stuck in limbo while deposits continue bleeding out. Bank number 12, Pacific Premier, California institution with heavy concentration in Southern California commercial real estate. Office properties, retail, exactly the loan types experiencing the highest default rates in exactly the markets, seeing the biggest value declines. Now, before you check whether your bank is on this list and either panic or relax, understand something critical. These 12 banks are examples. They represent institutions where public data shows multiple risk factors converging, but they're not the only banks facing pressure. The FDIC's official problem bank list contains 63 institutions. FAU data shows over 900 banks of any size with commercial real estate exposure exceeding 300%. Nearly $1 trillion in commercial real estate loans are maturing this year and next, forcing borrowers to refinance at higher rates into lower property values. Warren Buffett isn't dumping bank stocks because he has inside information about these specific 12 institutions. He's exiting the sector because the entire regional banking system is built on a foundation that's cracking. Higher rates, collapsing commercial real estate, deposit flight to safer alternatives. That's not a problem for JP Morgan, but for regional banks with concentrated exposures, it's potentially fatal. Here's exactly how it happens when a bank fails. Examiners spot problems during routine audits. They issue confidential warnings. They require remediation plans. They increase oversight frequency. During this entire period, customers see nothing. Branches operate normally. ATMs work. Websites function. Online banking processes transactions. The only people who know the bank is dying are regulators, the board, and senior executives who are criminally prohibited from disclosing anything to depositors. Not allowed to hint, not allowed to suggest, not allowed to give you any chance to protect yourself. When regulators finally determine the bank cannot be saved, they execute the Friday night seizure. Markets close, regulators move in, weekend negotiations to find a buyer or prepare for payout. Monday morning, you wake up to headlines that your bank is gone. If they found a buyer, your accounts transfer. If they didn't, you get a check for your insured deposits up to $250,000. Anything above that limit, you might get it back through bankruptcy proceedings over years, or you might not get it back at all. This isn't speculation. This is what happened to Silicon Valley Bank depositors, to Signature Bank customers, to First Republic clients. Thousands of businesses nearly missed payroll. People couldn't access funds to pay mortgages. The disruption rippled through entire communities. So what do you do to protect yourself? The 5-step framework sophisticated money uses. Step 1, spread money across multiple institutions. Never more than $200,000 at any single bank. Not $250, $200. Leave buffer room for interest and automatic deposits. If you have serious money, use 4 or 5 different banks. Inconvenient? Absolutely. Better than losing it? Also absolutely. Step 2, prioritize the mega banks for core deposits. JP Morgan Chase, Bank of America, Wells Fargo, Citigroup. These are globally systemically important institutions. Too big to fail isn't marketing, it's regulatory classification. The government cannot allow them to collapse without destroying the entire system. They're not perfect, but they're the safest place for money you cannot afford to lose. Step 3, understand Treasury bill alternatives. You can buy government debt directly through Treasury Direct. No bank intermediary, no failure risk, your money held by the Treasury itself. Money market funds investing exclusively in government securities offer similar safety with more liquidity. Not FDIC insured because they don't need to be. They're backed by the full faith and credit of the United States government. Step 4, monitor your bank's health yourself. Don't assume regulators will warn you because they won't. Bankregdata.com shows detailed metrics on every bank in America. Check commercial real estate as percentage of capital. Anything above 300% deserves scrutiny. Check unrealized securities losses as percentage of equity. Above 10% raises concerns. Check deposit trends over the past 4 quarters. Declining deposits while competitors grow is a red flag. The FDIC's own bank find tool lets you pull call report data on any institution. Look at non-performing assets. Calculate what's called the Texas ratio by dividing non-performing assets by tangible equity plus loan loss reserves. Anything above 50% suggests stress. Above 100% indicates serious trouble. This data is public, free, updated quarterly. Banks are required to disclose it. The only thing stopping you from using it is the false assumption someone else is protecting you. Nobody is watching your back. You have to watch your own. Step 5, act on warning signs before they become headlines. Buffett's entire philosophy: move on probability, not certainty. By the time bank failures hit the news, your money is already frozen. Move first, ask questions later. Better to be wrong and safe than right and broke. The warning signs are flashing everywhere right now. Commercial real estate markets collapsing, securities portfolios underwater, deposits fleeing to higher yields, over 900 banks carrying excessive commercial real estate exposure, $1 trillion in loans maturing into a refinancing nightmare. Buffett said something at his shareholder meeting that captures everything. The banking system is essential to American prosperity, but that doesn't mean every bank will prosper. Never confuse the safety of the system with the safety of any individual institution. The 12 banks I walked you through today are real institutions with real vulnerabilities documented in public regulatory filings, not guaranteed to fail, but facing elevated risk based on the same metrics regulators use to spot problems. Their customers deserve to know these risks exist so they can make informed decisions. Take action while you still can. Diversify your deposits, move core funds to the safest institutions. Consider treasury alternatives, monitor your bank's public financial data, and don't wait for warnings that will never come. If you found this valuable, watch another video here to stay ahead of what's coming next.